On March 23rd, 2026, 3 weeks into the US-Iran war, something strange happened. Donald Trump went on television. He said Iran was already ready to talk. He said productive negotiations were underway. He said that oil prices would drop like a rock once a deal was reached. And they did. 10% in a single day. Billions of dollars shifted. And then, 24 hours later, Tehran issued a statement. No talks were underway. No negotiations existed. Iran called Trump's announcement an attempt to influence financial markets. Oil climbed right back. And here's the question nobody in the mainstream media is asking loudly enough. If a single presidential statement, later denied, can move $1 trillion global commodity by 10% in a day, who knew it was coming? To understand what is happening, you need to understand one geographical fact. The Strait of Hormuz is 21 nautical miles wide at its narrowest point. Through that 21-mile gap flows approximately 20% of the world's seaborne oil. Every single day. That's roughly 20 million barrels, which means every country that manufactures anything, every airline that moves anyone, every hospital that runs on electricity, every farmer who needs fertilizer is permanently and quietly dependent on that 21-mile passage staying open and stable. Now imagine you could open and close that passage, not physically, but financially, with words, with signals, with carefully timed announcements. This is the story of how that has been done. Not through conspiracy, but through something more powerful. Incentive structures. The oil market started feeling this war even before the first bomb fell. In early January 2026, Brent crude was trading around $63 a barrel. Iran was in political turmoil. Trump was making threats, but no shots had been fired. By January 30th, with nothing physically changing, Brent reached $70.69 a barrel. Markets were already pricing in a war that hadn't started. Then, on February 5th, the US and Iran agreed to talks. Oil fell nearly 3% in one session. A week later, the International Energy Agency forecasted lower demand, and analysts said there was a good chance of solving the Iran problem. Oil dropped another 3%. 3 days after that, there were new fears of a supply disruption. Oil jumped 4% in a single day, reaching a 6-month high. Notice the pattern? Conflict signals and price rises. Peace signals and price falls. Conflict signals again and price rises again. This is not random market behavior. This is a market that has been trained over decades to react violently to signals from this specific region. And once you understand that, everything that follows starts to look different. On February 28, 2026, US and Israeli forces launched coordinated strikes on Iranian territory. The supreme leader of Iran was killed. Within 2 trading days, Brent crude jumped 8%. In the first week of March, WTI crude surged 35%, the biggest weekly gain since 1983. By mid-March, Brent was at $112. WTI hit $98. At the same time, petrol in Delhi was pricing at 94.77 rupees per liter and diesel at 87.67 rupees per liter. Iran at that time had declared the Strait of Hormuz closed. Major shipping companies like Maersk, CMA CGM, Hapag-Lloyd suspended operations entirely. War risk insurance for transiting vessels in the Gulf became prohibitively expensive. And here is where it gets interesting. While airlines collapsed, cruise ship operators tanked, and while logistic companies bled, shares of very specific group of companies surged. Northrop Grumman shares surged 4.09% on the first day of the conflict. RTX Corporation, maker of the Patriot system actively deployed, surged 3.79%. Palantir Technologies, whose software helps global defense agencies, surged 5.8%. And the oil majors? In the month following the outbreak of the conflict, BP surged 22.3%. Total Energies rose 16.7%, and Shell climbed 13.3%. These were not small moves. These were structural sustained gains. Investors were not pricing in a short war. They were, in the words of one analyst, structurally higher for the next 1 or 2 years. So we have to ask, who benefits from keeping this conflict unresolved? And here is where the plot thickens. By late March, direct military exchanges were slowing. The war had settled into a grinding standoff. Oil was above $90, and then the announcements began. On March 23rd, Trump says talks were underway. Iran says there are no talks. WTI drops 10% in one session, then climbs back 3% the next day. On April 1st, Trump gives a speech implying that the war is nearing an end. WTI jumps 11% in one session. On 7th April, Pakistan's Prime Minister makes a last-minute call to Trump, requesting a 2-week extension to allow diplomacy. Trump tells Fox News he is in. Markets cheer. On April 8th, a ceasefire is announced. Brent crude crashes 15.9% in one session. WTI plunges 16.7%. Stock markets, which had been bleeding for 6 weeks, suddenly surged. FTSE, which is simply the 100 largest companies listed on the London Stock Exchange, surged 2.8%. Equities rally globally. Investors rush to unwind their hedges. But what does that actually mean? When investors are scared, genuinely scared that oil prices will keep rising, that inflation will accelerate, that the global economy will slow down, they protect themselves. They buy financial instruments that will pay out if things get worse. Insurance, essentially. Expensive insurance. For 6 weeks, the entire financial world had been holding that insurance, betting in a sense on continued chaos, paying a daily cost to maintain that protection. And then the ceasefire was announced. And suddenly, the insurance was no longer needed. So investors rushed to cancel it, to unwind their hedges. That money, which had been sitting defensively on the sidelines, poured back into stocks, which pushed share prices upward, all at once. And then, within 24 hours, Israel strikes Lebanon. Iran says 3 provisions of the ceasefire have already been breached. Iranian media reports tanker traffic through Hormuz has been suspended again. Oil climbs back 3%. Charles Schwab's analysts put it plainly. The ceasefire rallies they wrote look to be driven not by any fundamental resolution, but by rapid unwinds of hedges and speculative positioning. In other words, the market was not responding to peace, it was responding to the signal of peace. Rabobank strategist Molly Schwartz noted that crude's sharp drop on the ceasefire announcement had been only partially reversed by the time Iran resumed restrictions. She highlighted that a temporarily lower oil level could cushion future price spikes if hostilities resumed, suggesting in her words that markets may be factoring in a tactical US strategy. Let's slow down and map what we are actually looking at. Because this is not random. This is a cycle. And every turn of the cycle moves money. And once you notice the patterns, you can't unsee them. Every one of these moves was triggered by a diplomatic signal, not by a change in the physical supply of oil. The Dallas Federal Reserve documented this mechanism precisely. They noted that during the Israel-Iran 12-day war in June 2025, the probability of Strait of Hormuz closure surged to 53%. WTI peaked at $75 per barrel. Then a ceasefire was announced. Prices retreated. But here is what the Dallas Fed recorded. The strait never actually closed. The market had priced in a catastrophe that never occurred. And then someone sold the fear at the top and bought back in at the bottom. This is not a conspiracy theory. This is what economists call tail risk amplification. The oil market is structurally designed to react to the probability of disruption, not the disruption itself. And in this environment, a carefully timed tweet is worth more than a pipeline attack. The ORF Middle East documented what happens when a resolved crisis leaves a permanent scar. After the Houthi Red Sea attacks declined in 2025, transit volumes through the Bab al-Mandab Strait remain 65% below pre-conflict baselines, even with the reduced physical risk. Because the perceived risk never fully priced out, Barclays said it explicitly. Now, we need to ask a question the press rarely asks directly. In a volatile market, who wins? The oil majors win. They sell the same barrel for twice the price. The defense primes win. Trump personally met with defense executives and floated a substantial supplemental budget request, signaling, in the words of one analyst, that Washington expects a prolonged draw on military stockpiles. Northrop Grumman tested all-time highs. RTX, whose Patriot and THAAD systems were actively deployed, cleared a major technical pivot. Spectacular wins. Anyone who bet on oil prices rising before February 28 or bought in cheap every time a ceasefire was announced walked away with enormous profits. And then there is the silent beneficiary. The Middle East Council on Global Affairs called it the most striking paradox of the entire conflict. Every dollar Brent rises above $80 is a dollar that partially offsets Western sanctions on Russian energy exports. Every month the Strait of Hormuz stays disrupted is a month that European buyers are forced to scramble for alternatives, often at prices that indirectly support Russian gas and oil reserves. Russia did not fire a single shot in this war, and yet it may be collecting the largest economic dividend. S&P Global Energy calculated that by late May 2026, 1.2 billion barrels of oil had been disrupted since the war began. Every barrel of that disruption was a data point that told commodity markets the world is less safe, oil is more scarce, price accordingly. And that brings us back to 23rd March. Trump says talks are underway. Oil drops 10%. Iran calls it an attempt to influence financial markets. Oil climbs back. One of those statements was a lie, but the money moved either way. The Atlantic Council framed the mechanism precisely. They called it a geopolitical put option. The idea that policymakers can, through timed language, timed pauses, timed escalations, actively manage the price embedded in global asset markets. Not through supply, through signals. CNN reported as recently as May 26th that despite ceasefire talks progressing, the Strait of Hormuz remained closed. Fuel prices were heading towards an all-time high. More than 1.2 billion barrels had been removed from the global supply chains, and oil traders, analysts, and fund managers were watching, not the battlefield, but the next announcement, the next signal, the next time a statement was given from a podium. And here is what the data tells us. The price of oil has moved by double digits at least 5 times since the war began. Each time triggered by a diplomatic signal, not a physical event. The market has been trained over decades to price fear, and in that training is a vulnerability. Because if fear alone can move the price of the commodity that powers civilization, then the power to create fear and to end it and to create it again is the power to move the world's economy. The question is no longer whether the Strait of Hormuz will reopen. The question is who decides when and who gets to profit from that announcement.